We started this series by touching on the risk-reward relationship, and we talked about the different types of investments available in the marketplace. For now, let's turn our attention to some of the risks associated with these investments. Did you know that even if you place your cash in a secure bank vault and hire a private security guard to protect it, you still face investment risk? At the end of this lesson, I'm betting you'll know which risk applies, but we'll also open the vault and show you. In this mini lesson, I'm going to cover 5 basic types of investment risks with a simplified example of each. Default risk. This is the risk that the issuer fails to meet its obligations. For example, a bond investor is relying on the issuer to make interest and principal payments as agreed. Default risk is the risk that they don't. Market risk. Even the most diversified portfolio is subject to market risk. For example, even if you owned an ETF fund that is designed to mimic the return of a certain stock index, which would of course be a well-diversified investment, if the entire market crashes, you're going to lose money. Inflation risk. Inflation refers to the prices of goods and services that we use increasing, such as groceries, fuel, appliances, haircuts, etc. The rate of inflation is measured by something called the Consumer Price Index, or CPI. Inflation hurts investors, especially those living on a fixed income. For example, if an investment generated a 5% return, while inflation was 2%, the increase in purchasing power, or real return, is only 3%. Interest rate risk. In an earlier lesson, we discussed fixed income investments. Recall that if interest rates increase, it puts downward pressure on the market value of existing fixed income investments. This is referred to as interest rate risk. And finally, foreign exchange rate risk. If you invest in securities denominated in currency other than Canadian dollars, you are facing foreign exchange risk. Even if the value of your security increases in the foreign currency, you could still lose money when you convert the currency back into Canadian dollars if the exchange rate moved against you. So, which risk applies to sticking your money in a vault? Well, let's open it and see. 25 years ago, it was enough to buy a pretty nice car. Today, it would only buy a motorcycle. This is inflation rate risk.